When people hear the word war, they imagine missiles, airstrikes, and political speeches. But the real battle, the one that decides how long a country can survive, is fought quietly in bond markets, central banks, and currency exchanges. Wars are not just military conflicts, they are financial stress tests. And when you compare the United States and Iran during a time of conflict, the biggest difference is not just military power, it is financial control. Let's start with the simple truth. War is expensive, extremely expensive. It drains government budgets, increases borrowing, disrupts trade, and shocks global markets. So the real question is not just who has stronger weapons, it's who has stronger financial infrastructure. In the United States, financial control does not sit in one person's hands. It operates through institutions. At the center of this system is the Federal Reserve. The Fed controls interest rates, manages money supply, stabilizes banks, and injects liquidity during times of crisis. When oil prices spike because of geopolitical tension, inflation risk increases. The Fed can respond by adjusting rates or tightening policy. If recession risk rises because of market instability, the Fed can shift direction and support growth. That flexibility is financial power. At the same time, the U.S. Treasury plays a crucial role. When military spending increases, the U.S. government doesn't rely on emergency cash printing alone. It issues Treasury bonds. Investors around the world, pension funds, hedge funds, insurance companies, and even foreign governments buy that debt. Why? Because U.S. Treasury bonds are considered one of the safest financial instruments globally. They are backed by the world's largest economy and the world's reserve currency. And this is where the dollar advantage becomes critical. The U.S. dollar remains the dominant global reserve currency. International trade is largely conducted in dollars. Oil is priced in dollars. Global banking settlements run through dollar-based systems. When global fear increases, capital often flows into dollars instead of away from them. That means even during times of conflict, the United States can experience capital inflows rather than capital flight. In simple terms, when uncertainty rises, investors want liquidity, they want deep markets, they want stability. The U.S. financial system provides all three. That creates resilience. Now compare this to Iran. Iran operates under heavy financial sanctions and restricted global access. Its central bank does not have the same global flexibility as the Federal Reserve. It cannot easily access international capital markets. It cannot issue globally demanded debt at scale. Its economy relies heavily on oil exports as a primary source of foreign currency revenue. That concentration creates vulnerability. When war escalates and oil exports face disruption or tighter sanctions, Iran's revenue declines. When revenue declines, foreign reserves shrink. When reserves shrink, pressure builds on the national currency. As the currency weakens, import costs rise. As import costs rise, inflation accelerates. That cycle can destabilize the domestic economy quickly. Unlike the US, Iran cannot rely on massive international demand for its bonds. There is no deep global investor base ready to absorb Iranian government debt during crisis. That limits its ability to finance prolonged conflict through borrowing. Its financial survival becomes more dependent on internal control and alternative trade channels. Oil plays a central role in this financial comparison. For the United States, rising oil prices can increase inflation and consumer costs, but the U.S. is also one of the world's largest energy producers. It has diversified revenue sources, large domestic markets, and strategic reserves. For Iran, oil is not just part of the economy, it is the backbone. If oil flows are disrupted or sanctioned, government revenue feels the impact almost immediately. Another critical difference is investor confidence. During global instability, institutional investors often move money into U.S. Treasury bonds, the U.S. dollar, and other dollar-based assets. That capital movement supports the U.S. financial system even when headlines are negative. Money seeks safety and liquidity. The U.S. financial system provides deep capital markets and regulatory stability that global investors trust. Iran's markets do not offer the same depth or accessibility. Sanctions limit foreign participation. Currency volatility reduces confidence. That makes capital flight more damaging and stabilization more difficult. Survival strategies also differ significantly. The United States survives financially by leveraging markets. It funds spending through bond issuance. It uses sanctions as financial leverage against adversaries. It adjusts monetary policy to stabilize inflation or growth. It supports financial institutions during volatility. It maintains confidence in the dollar system. Iran survives through control and adaptation. It manages limited foreign reserves carefully. It seeks trade partnerships outside Western systems. It attempts to stabilize its currency through intervention. It relies on domestic economic management rather than global capital inflows. But these tools are more limited in scale and flexibility. In modern economic warfare, financial endurance matters. A country that can borrow at low cost, maintain investor confidence, and stabilize its currency can sustain prolonged pressure. A country with limited access to global capital faces faster strain. The bond market becomes a silent battlefield. In the United States, strong demand for treasuries lowers borrowing costs and signals investor trust. In Iran, limited bond market access constrains financing options. The currency market becomes another battlefield. A strong dollar increases purchasing power for imports and stabilizes domestic prices. A weakening currency increases inflation pressure and reduces purchasing power. For investors watching this situation, the financial signals matter more than political rhetoric. When fear rises globally, gold may increase as an inflation hedge. Oil may spike due to supply concerns. The dollar may strengthen as investors seek liquidity. U.S. bonds may rally if recession risk increases. These capital flows reveal which system the market believes is more resilient. The real power difference lies in institutional structure. The United States operates within a globally integrated financial framework supported by reserve currency status, deep bond markets, and central bank independence. Iran operates within a constrained system shaped by sanctions, limited reserves, and concentrated revenue sources. Wars test economic systems. They expose weaknesses in currency management, debt sustainability, and capital access. They amplify structural advantages and magnify structural vulnerabilities. In the end, financial control during war is not about one leader making decisions. It is about which country has deeper markets, stronger currency trust, broader investor participation, and more flexible monetary tools. The visible battlefield may dominate headlines, but the invisible battlefield, the flow of capital, the strength of currency, the depth of debt markets, determines economic survival. The United States enters conflict backed by global capital markets. Iran enters conflict constrained by limited financial access. That structural difference shapes resilience. Because in modern geopolitics, power is not measured by military capability. It is measured by the ability to finance, stabilize, and sustain. And in that quiet financial war, control over money often determines who can endure the longest.